Hi, I'm Lance Roberts with Clarity Financial, and I want to spend a few minutes today talking to you about how we manage 401k plans at Clarity Financial. I recently sent out a tear sheet and some updates on information about our 401k plan and our 401k portfolio, but we got a lot of requests for further explanations about how our portfolio management process works. So for all of you more technically inclined individuals that are willing to go through the minutia, well, we're going to go through it today so you'll clearly understand how our process works and how we actually manage risk within portfolios over the time. We at Clarity Financial don't believe in buying and holding investments long term. We believe that managing money over time generates a better rate of return by avoiding the major losses to portfolios over time through market crashes. In other words, spending less time making up losses and more time actually growing portfolios towards financial goals. And again, that's what we want to do with a 401k plan, in particular, where we have tax-deferred savings as well as 401k contributions provided by the company. Any major losses to portfolios destroys both of those compounding effects over time. So let's go through our process in detail, and I hope you'll find this helpful. First of all, go to our website, realinvestmentadvice.com, and click on the newsletter link, and that's where you'll find our weekly newsletter. Now, we're going to be sending this to you directly every week, but you can also find it on our website every single week. And if you want it emailed to you, you simply click the subscribe button, put in your email address. It'll automatically be emailed to you every Saturday when I produce it. But again, like I said, we'll also as a service be providing it to you directly through your company email. Now, if we look at the 401k plan manager, which is at the bottom of the newsletter, you'll see this chart that we've been running since 2006. Now, we've actually been managing this model ever since 1999, but started actively tracking it in 2006. And this is based upon 4 signals that I'm going to go through with you today. There's a lot that goes into building our models and how we run them, but the basic premise is that when we reduce risk to portfolios, it is tended to typically protect capital and allow for a better growth rate of returns over time. We do this by adjusting the risk in the one area of the portfolio that tends to be impacted the most by falling prices, which is equities. So we simply shift the portfolio from equity exposure into cash and from cash back to equities. This allows us to control that risk over time. Currently, as of today, we're actually recommending a reduction in risk, moving from 100% equities down to 75% equity exposure in portfolios because of what's going on with the markets currently. Now, this will change as environments change and as economic risk changes. But what drives our portfolio asset allocation and our sector analysis, what we call our sector rotation strategy over time, is what happens between economics and what happens in financial markets. As the economy goes through recovery, we begin to see what sectors tend to perform better during early recovery cycles to late cycles, and we monitor those changes to sectors accordingly so that as some sectors are outperforming, we overweight those, we underweight sectors that aren't, and vice versa. As we go through the market cycle, we also notice 2 other things that occur. At the bottom of major market corrections, value investing begins to outperform things like growth or momentum investing. And later stages of the markets towards market tops, momentum tends to outperform value. So we also adjust not only the sector rotation between what's performing economically and what's not, but we also rebalance the portfolio between value and momentum based on where we are within the current investment cycle. Well, so the question becomes, how do we determine that? So we go through this process by doing an equity selection style recovery, which is looking at this universe of the S&P 500, the S&P 1500, or in the entire universe of stocks in general. We then begin to mold those down into value, growth, and momentum, watch which candidates are working versus not working, and then begin to screen against our criteria that we want for our fundamental values, because we are fundamental investors, but we use a technical overlay in order to determine when and where to make investments. Ultimately, we move on to the portfolio construction process once we've determined where we want to be invested. Currently now, as we speak today, momentum is outperforming value. So currently our portfolio is tilted more towards a momentum type structure because that's what's working in the markets. Outside of that, we then begin the process of determining how and when to make exposure changes to portfolios. This starts by running all of our positions against our screening sections, and then we begin to determine between what is working and what is not working, making decisions as to when to move a position to a sell or to an alert. In other words, do we begin to take money off the table? Do we sell it entirely? Or do we just simply watch it closely until what happens next? Of course, once we're talking about fundamentals, fundamentals are a long-term driver of portfolios. So this is where we add this technical overlay, and the technicals in terms of price analysis, etc., determines when we should actually act upon, well, buying or selling. And this particularly becomes the case during a selling process within the portfolio, because as markets decline and sell signals are triggered, by the time we get a sell signal, the markets tend to be oversold. At that point, we began looking for a bounce in order to allow us to execute out of a position at a better price. That way you don't wind up getting kind of the panic sell type scenario at the bottom of markets. In other words, selling low and turning up to buy high. We want to actually do the opposite, which is to buy low and sell high, which is what works out better over time. As we go through this process and looking at the primary portfolio structure, we compare that structure to our benchmark. So in our 401k plans, our benchmark remains the S&P 500. We overweight or underweight our portfolio relative to the overall benchmark index. So as the S&P 500 is moving up or down, we then begin to break that market down, break the index down into its components, and begin to overweight or underweight sectors that are or are not performing within that index. As we go through this process, we look at the position, we look at the fundamentals of that position, and the technicals. Depending on what is improving, in other words, if fundamentals are improving, better or same or worse, that then begins to tell us to hold or add to that position or to sell it. The same thing occurs with the technicals. We can have a good position, but if the technicals are breaking down, that also dictates when we add, hold, or sell a position. Now, as we go through this, these begin to line up into two different structures. If we have a fundamental buy and a technical buy, we either hold or add to that position. Obviously, if we have a fundamental sell and a technical sell, that position gets sold. So each one of these decision-making trees allows us to focus better and to provide an actual management structure to overall 401k plans. The technical criteria is the important part of this that a lot of people need us to explain. And this is really what drives the 401k plan manager in the newsletter. So when you look at our 401k plan, there's 4 signals that drive our overall equity allocation changes. The first signal is simply an alert. This is when we get an initial sell signal on the markets, and typically, like I said, by the time we get that initial sell signal, the markets tend to be oversold in the short term. That alert simply tells us, kind of like a yellow traffic light, just to simply pay attention. Doesn't mean we actually do anything at that point, but we are beginning to take a much closer look at our holdings and beginning to evaluate each one of the positions that we own. As the second signal comes in, this then tells us that we need to begin reducing our equity allocation by 25%. So if I have a 60% weighting of equities in a portfolio, I'm going to reduce that to 45%. Again, by the time that second signal comes in, the market's oversold, so we begin looking for a bounce to reduce equity allocation risk. As the third signal comes in, that takes us down to 25%. And then lastly, our last position, which is a big issue. This is when we have major market moving average crossovers. This is when you have now broken the trend of the market. The trend of the market is no longer trending positively. It's now negative. We actually take our portfolio allocation all the way down to just 15% equity out of a 60-40 model. Now, here's the important point. We never go to zero. The reason we never go to 0% equity is because of two things. One, we're not market timers. We're simply portfolio managers. The second thing is that when you go to 0% cash or 0% equity and 100% cash, it's extremely difficult to move back into the markets. Take an example, 2009. In February of 2009, I wrote an article, 8 Reasons for a Bull Market. At that point, people told me I was crazy because, well, the markets were going to zero. Of course, March of 2009 was the bottom of the market. By maintaining some equity exposure, it allows us to mitigate risk within portfolios to a great degree. Think about this for a moment. In a 60-40 model, that only has 15% exposure to the markets, if the market declines 10%, the portfolio is only down 1.5%. A 40% decline, the portfolio is down only 6%. That's very reasonable within a portfolio allocation recovery process to only recover from a 6% decline versus 40. That doesn't even include the interest income or the participation that we got out of bonds at that point that would have also mitigated that risk even further. But by maintaining some exposure, it's easier to begin moving back into portfolios and beginning to rebuild equity as markets begin to recover after a major correction. The same thing occurs at the peak of markets. When we begin to see those trend changes and we begin to see those things, we begin to reduce or build equity exposure accordingly. In our portfolio management process, we use two signals that primarily drive our first three indicators, our alerts and our second two confirmed sell signals. These are a combination of a shorter term and an intermediate term signal. The reason we use multiple signals is to confirm what each signal is saying. So when our first signal issues an alert or a sell signal or a buy signal, the second signal then comes in a little bit later as markets continue to either deteriorate or improve and confirms what the first signal was telling us at the beginning. This allows us to make more determined decisions in portfolio management processes over time without knee-jerking a reaction to a short-term signal. This happens a lot with technical traders, and they get frustrated with technical analysis because they get whipsawed in and out of positions. By using a measured approach to technical analysis with confirming signals, it stems the number of false signals that tend to occur. Let me show you this going back to 1998 when we began actually running this model. In 1999, we began to get early signals that this market was becoming, well, extremely overbought and more risky. In 2001, as the markets began to deteriorate into the dot-com crash, we then got all the sell signals coming in to reduce equity allocation models down to their lowest level. In 2003, the signals began to reverse and tell us to start putting money back into the markets again. Those signals stayed on buy signals until 2007 and early 2008, where the markets began deteriorating back into the financial crisis. Now, the difference is, as you'll notice, in 2009 and 10, 11, and 12, we began to get more signals more frequently. And this is because of the intervention of the Federal Reserve and quantitative easing programs, which have led to a lot more volatility in the markets. So over the last decade, we've had to be much more proactive about managing money because of increased price volatility that have occurred. And this is continuing to be the case as we go forward. If we look at our longer term chart here, you can see exactly where these signals have lined up with major market reversions and changes. And you see there's a very close alignment between market peaks in these signals and market bottoms and buy signals. Currently, we remain on a buy signal. Currently, we've got our first two signals now coming into play, which is why we're reducing risk to 45% equity currently in portfolios. That could change. And if it does, then we'll reallocate portfolios back to 100% equity. But typically, these signals don't line up and then rapidly change back because, again, these are intermediate term signals based on weekly data rather than daily data. So generally, when we start getting these signals, they're more important ones to pay attention to, like we are today. But going on with this is how the signals actually work out within portfolios. Signal one, like I said, is an alert only. This is where we begin to look at things like, well, positions that simply aren't working, trimming back exposure in areas that we don't want to be in. Signal 2 requires a bigger increase in reduction. We reduce the allocation by 25%. This is where we use the rally to sell laggards, trim winners back, take profits. Signal 3, the action, again, we reduce another 25% here. This is where we begin to sell underweight market positions, things that have been long-term winners now become out of the portfolio, beginning to raise a lot more cash. And signal 4 is where we have a really serious change in market direction. This is where we get to the lowest level of equity exposure. We're simply holding major market indexes at that point, simply just as proxies for the overall market, and looking to hedge off that risk by doing things that we can, such as shorting markets, adding more fixed income, doing those type of things. So the goal when we get to signal 4 is to actually take the portfolio to a market neutral position by actually hedging off that remaining little bit of equity. When markets finish their correction process and we begin to see recovery, we remove the hedges first and then begin to buy back into the equity allocations over the long term. Now, here's some of the portfolio management rules and guidelines. Our portfolio is driven by three primary factors: a technical overlay, as I said, the fundamentals, which are the primary drivers of what we buy, and then we also look at what's called reversions. And reversions are where markets get so extended from a long-term mean that you're going to get a reversion back to the mean. Reversions are a key critical component to long-term portfolio actions as well as market actions as well. If over time, whenever markets have gotten as extremely deviated from long-term moving averages as they are now, that reversion to the mean has always occurred. Always occurred. And the question is only how deep and how meaningful those reversions have been. In 1999 and 2007, and probably coming up in 2018 or 19, the reversion back from the long-term means where we are now are going to be pretty substantial for financial markets. Lastly, when we take a look at this technical fundamental and reversion process, again, our tree of indicators comes out to tell us that when we have trends in technical analysis, in other words, price trends are beginning to notate a change, when fundamentals such as earnings, etc., are beginning to deteriorate and valuations are extremely expensive as they are today, and you take a look at the reversion process, in other words, how far are we deviated from long-term means, when all those three things begin to overlap, it tells you that a lot of the risk in markets is currently built into stock prices, and that's when we're going to be more careful about managing exposure to portfolios. And lastly, this is where we really come up to the bottom line, is that these trend reversions and trend changes are what we want to avoid in our portfolio and 401k plan management process. I'm your host, Lance Roberts, of course, with Clarity Financial, and I hope you've enjoyed this brief explanation about how we manage our portfolios and manage our money in 401k plans in particular. I invite you to go by our website, Real Investment Advice, subscribe for our newsletter, and feel free to ask questions at any time about anything that you want to know about how we're managing money and what we're doing inside the 401k plan itself. Thank you again.